ask great questions.
Coming off the back of the biggest weekly gain on the S&P 500 since November. That was last week, the biggest weekly gain since November. Trying to build on that this morning. Good morning to you. About seconds away from the opening bell. Equity futures up by 0.6% on the S&P. On the Nasdaq 100 up 0.75%. On a Russell up by 0.8%. There's your opening bell. Switch at the board and get to the bond market. Monster move on Friday off the back of that ISM. Yields lower, much lower at the front end. Trying to bounce this morning on a 10-year yield up by a couple of basis points to 357.82. The ECB signals there's more hikes to come. Euro dollar reclaims 107.17 on euro dollar. Positive there by 0.7%. And crude trying to rally here. We'll talk about China and reopening with Damien Sassower at Bloomberg Intelligence in about 15 minutes. Look out for that conversation. Crude up by 2.5% to $75 and around about 60 cents. Around about 25 seconds into the open here, equities up by 0.5% on the S&P. On the Nasdaq up by 0.9%. One name to watch at the open, Lululemon, plunging after the company cut its margin forecast on surging costs. Abby has more on this one. Hey, Abby.
Hey, John. Well, yes, Lululemon appears to be the first, maybe the only, but certainly the first of the retailers to admit that holiday 2022, well, it wasn't so good. And this is not a new story. If you recall, in early December, they reported a brutal quarter, all about margins not coming in where they were supposed to, profitability not as high as expected. And so this is weighing on other retailers. Well, not as much anymore. Under Armour and VF Corp coming off the lows. But relative to those gross margins, it's a pretty significant shift that they have made in a press statement initially this morning, and that is that gross margins, instead of being up 10 to 20 basis points in the fiscal fourth quarter, the quarter we're in now down 100 basis points, now, or 1%. So this now means 4 straight quarters of contracting gross margins. My thought, as similar to early December, get over to that Lululemon on December and see what great deals they have. But this, of course, translates into weakness for the stock, the worst day for the stock of the year. Now another down year, knowing that the year is young. But the reason this matters, well, actually, it's actually up just slightly on the year there. But last year, a down year, John, the first time since 2013. Will this company be able to get it together in time? We don't know, but perhaps not the best way to start the year after having been higher last week.
That's for sure. Abby, thank you. Stocks hammered, down by about 10% in early trading. Different story for Alibaba, the stock leading Chinese tech gains, with the PBOC announcing an end to its 2-year crackdown on the sector. Ed Ludlow has more. Hey, Ed.
Yeah, good morning, Jonathan. Beyond sort of being caught up as part of the China reopening trade, there are 2 key catalysts with Alibaba's stock this morning. The first, a comment from a top central bank official in China, Guo Shixing, who basically says that the 2-year crackdown on China tech focused on those 14 internet companies and their financial business is basically or essentially coming to an end. At the heart of this story has been Jack Ma and him stepping back from Ant Group, the financial affiliate of Alibaba. The other key catalyst was on Saturday, the company appointing 10 individuals, giving them voting rights, which essentially strips Ma's control from the company. It's been a really interesting story. Look at Alibaba's stock over the course of 2022. Very difficult year. And while that chart doesn't fully demonstrate it, from the trough in October to present, we've actually rebounded some 70%. A part of that is the reopening trade, this idea that growth estimates for China in 23 are improving. Then there's the specific equity story. You look at analysts' calls on this stock, the percentage of buy ratings improving in recent weeks. Goldman Sachs, for example, has added Alibaba to its conviction list, both on this kind of reopening and recovering conviction call, but also that improving regulatory environment. And then Alibaba is Morgan Stanley's new top pick for this year. They're also interested in other internet stocks in China like Meituan. I think there's kind of some growing optimism about the growth story in China for 23, particularly for tech, particularly for e-commerce. That said, we're still concerned about the spread of COVID-19.
Big time. That stock is up by 4%. Ed, thank you. As always, it's not just China tech. EM equities. EM equities are up more than 20% since the lows of October. As I say, we'll catch up with Damien Sassower in just a moment on that. But what a run. They say there's always a bull market somewhere. That's where that bull market is right now. The big banks here in the United States kick off earnings on Friday. JP Morgan goes first, Goldman next week. They're set to kick things off on a gloomy note this week, though, preparing to announce more than 3,000 job cuts as soon as this week. Shanali, run us through it.
Certainly, John, you have a tense week over at Goldman Sachs with a headcount reduction of that size. But
but listen, we knew it was coming, and it's actually a number that was less than it could have been. At the end of the day, Goldman has grown dramatically, and this number is bigger by the amount in terms of the cuts you're seeing. But let me put this in a perspective for you a little bit, because as we head into bank earnings season, it's a focus here on profit. What levers do the banks have to keep costs under control? And if you look at how much net income has dropped off between 2021 and 2022, if they're estimated to bring in that $11.8 billion of net income that analysts are expecting for the full year, that works out to $239,000 per worker. That is way less than you saw per worker just a year before that at $490,000. So $490,000. So you really have a steep drop off here, not in just kind of the pure employee count. If you look at it there, it's really not even bringing you back down to where you were even in 2020. It's barely bringing you back down to where you were a year ago. But what it means here to make a cut of this size, it makes a big difference to Goldman's bottom line, which is why you're seeing the stock really react positively to a lot of these plans that Goldman is putting out for you.
Sonali, they report next Tuesday, on the same day we hear from Morgan Stanley as well. Bit of a change at the top this morning. Run us through the latest.
Huge change at the top. Jonathan Pruzan was this chief operating officer, was the former CFO. Remember, John Pruzan has been there decades. He was a top deputy to James Gorman. By the way, when you look at the top ranks of Morgan Stanley, now you have John Pruzan gone. About a year or so, Shelley O'Connor, a different deputy, had left. You have the top of Morgan Stanley changing, and therefore the line of succession honing in. Puts the eyes very firmly on two particular folks. That is Andy Saperstein, who runs Wealth. That is Ted Pick, who is the king of the institutional securities business. And by the way, the reason this is so fun to watch, John, it is a competitive year, especially from Mr. Pick over there. Watch those trading figures come in. Remember, Goldman has been neck and neck with that business at Morgan Stanley equities that they loved to win that for so long.
Looking forward to your coverage that really kicks off on Friday. Sonali, thank you. JP Morgan earnings just around the corner on Friday. Those two banks we mentioned, Goldman and Morgan Stanley, coming up next week. From financials to tech, you know the story, the job cuts rolling in. Here's what Richard Bernstein of RB Advisors had to say.
This was a sector that was in full-fledged bubble mode for a couple of years. They hired indiscriminately, and now they're feeling the downward pressure on that. There's still way too much talk about, will the old leadership regain form? Right? In other words, should you look at this as a buying opportunity in this old speculative leadership? I think that's a very bad sign, because it shows that there still hasn't been full capitulation yet in these sectors of the economy.
I want to continue this conversation with Dan Suzuki of RB, joins us right now. Dan, I think you guys are really leading the effort on this front, and I'm not sure many people have capitulated to your view just yet. So Dan, let's start there. How long do you think it's going to take to unwind the excess that's been built up, not just over the last couple of years, but maybe over the last decade?
Yeah, John, good morning. Clearly, it's going to take a lot longer. I mean, this is just par for the course for how, bubbles deflate. When was the last time you saw a bubble deflate overnight? It takes years to really change the psychology and change the positioning around, how people view these things. I mean, for years, we've been taught that, the hopes and the stories were really all that you had to care about. But now that when it comes down to these points where liquidity is tightening, the economy is slowing, you have to come back to fundamentals and profits, and these are areas where people's expectations are way too high. It's going to take time for those things to change. Clearly, they are shifting, but I think it's going to take, a lot longer, a lot cheaper valuations, and people just stop it, people changing the way, they think of these as, huge opportunities for these stocks. I mean, one way to think about it, a rule of thumb for bubbles is, it typically takes, a decade to regain those highs, from the bubble peaks. It took, that long. It took 14 years in the case of the tech bubble. It took, that long in the case of most bubbles. So I think that's kind of a starting point for expectations.
Dan, this is not a new conversation for you and I. We talked about this, that lost decades aren't unusual. They're not unheard of. Do you think we could really be in for one at the index level in the United States for large caps?
I think a lost decade, John, is kind of extreme, at least for a base case scenario. But certainly, as you look at the U.S. relative to pretty much everything out there, it does face a lot of headwinds. I mean, the U.S. is still, probably the only major market in the world that's still actually quite expensive relative to history. And that's very much because of that bubble concentration in those bubble assets we mentioned. I mean, the concentration, the tech-heavy sectors has come down from 50% to the low 40s. But that's, there's probably a lot further for that to come down. And having such a high concentration in those bubble assets, which again are going to take a long time, to regain those highs, it does make for a tough decade outlook, for the U.S. market and the index, which is why, I think that, the real opportunity is people, look to take advantage of these down markets and cheaper valuations overall is actually go look for the stuff that's actually cheap right now. And that's the further away, you get from the bubble, that's where probably the opportunities are. So if the last decade was about disinflation and U.S. large cap growth, and I think the opposite of that is probably going to be the real opportunity. So pro-inflation, international small cap value, those are the things that people should be looking at, to take advantage of for the next 10 years.
So Dan, if you also believe then we're in for a period of structural inflation, not structural disinflation, what does that mean for the 60-40 story that people are still married to?
Yeah, I think it presents a tougher scenario for the 60-40. I mean, the thing about the 60-40 is that it was a very good way, an easy way to just have a buy and hold strategy and sort of mitigate risk. So I think that story of just the buy and hold strategy on the 40% that represents bonds, that's not going to be the case anymore. I think you can still take advantage of bonds and duration in portfolios. It's going to be a lot more tactical in nature. I mean, I think, as a starting point, just think back to these periods of higher inflation. There were huge opportunities to be had in bonds and duration, but you had to be very tactical. I think one of those opportunities is probably right now. I think the next year, bonds actually present a really attractive opportunity, as I think that the long end of the curve is probably going to come down as growth slows. But when we start to recover, you're going to want to be out of that trade, and so it's going to be a lot more tactical of a 60-40 going forward.
Can I talk to you about the tactical story on the equity side as well? So you've given me the more long-term, sustainable, fundamental story on equities, Dan. What about the near term? So Bank of America had this to say on Europe. We think the next big story for markets will be a sharp loss of growth momentum in response to aggressive monetary tightening. This is not yet priced, with markets buoyed, or buoyed as you might say, here in the United States, by strong activity on easing supply issues, fading gas prices and China reopening. So Dan, I get it in the near term. EM's ripped, China's ripped, China reopening, all of that good stuff. The energy story's faded a bit in Europe as well. Give me the tactical story for stocks in the near term, Dan.
Yeah, I think the tactical story and theme for the near term, John, is very simple, and it's very consistent with what we've been saying for a while. In an environment where we're just going into a profits recession globally, liquidity is continuing to tighten. I think that's an environment where the number one theme in portfolios right now should be defense. Now there's going to be periods where markets rally, but I think this is probably the worst combination of fundamental factors, to be, pedal to the metal on risk in portfolios. So I think, for the time being, you want to focus on defense. There will be opportunities. There are opportunities today to play offense, but there are going to be huge opportunities, over the next 5 to 10 years, to have huge gains and take advantage of that upcoming bull market. But for the time being, when we're just now entering into a profits recession, I think defense is probably the more important factor.
Let's talk about those opportunities in just a moment. Dan Suzuki's going to stick with us. Coming up on this program, China opening its borders and giving EM a major boost.
The China reopening, which we may debate whether it is a global scale event or not, but it's certainly an EM-wide relevant event.
That conversation up next.
the China reopening, which we may debate whether it is a global scale event or not, but it's certainly an EM-wide relevant event. You have very attractive valuations and a dollar cycle that has finally turned, coupled with the peak in interest rates. So we all know it's the best time to be overweight emerging markets, both equity and fixed income.
China taking the final step in dismantling COVID-0 and opening its borders. This as officials consider wider budget deficits to ramp up economic support, driving emerging market equities towards a bull market. For more, Damien Sasson of Bloomberg Intelligence joins us right now. EM equities, Damien, ripping.
Yeah, no, exactly. Markets are looking straight through China's let-it-rip approach and basically pricing in the good news after the bad, right? I mean, so I think where we are here is, it's tactical. I think, I think people have said it on your show earlier, best. I mean, so I think it's going to be a tactical upside here. We see broad dollar weakness taking hold. We see EM currencies largely led by the Asia-Pac region all rallying, and I'm talking Thai baht. We talked about that just a few days back. It's Korea as well. And so look, that's spilling into the broader EM equity universe. But Jonathan, we must remember that the EM equity universe is China, and it's largely 4 stocks. I'm talking Alibaba, Meituan, JD.com, you know the rest. So, I mean, it's a tech play. And so what are the legs there in this environment with the U.S. coming into recession? The verdict is still out.
Have you got a final word on Brazil?
So, of course. So, I mean, basically, yeah. I mean, look, I actually had a deck that came out. It was good timing this morning about how, basically EM practitioners have gotten used to living with geopolitical risk. And we've seen this now in Peru, Chile, Colombia. We're going to see it in Argentina at the end of the year. Jonathan, this is really nothing new for Brazil. We saw riots in 2013 and 2017. Now, the one takeaway here is this definitely undermines the credibility of the right, basically, in Brazil. And what that means is that Lula's spending caps, he might have a lot more durability to enact a lot more spending throughout the course of his tenure. And so that's bad for the Brazilian real. And I think the real is sort of reacting to that at 5:30 this morning.
Getting hammered. Damien, thank you. It's good to catch up, sir. As always, Damien Sasson there on this massive rally you're seeing in the equity market, in emerging markets. Dan Suzuki of RB Advisors is back with us for a final thought. Now, Dan, if I said rate cuts to people, they'd be frothing at the mouth maybe, thinking about buying big tech. And I imagine you're thinking about emerging markets in a bigger way. Is that right?
Yeah, I think, I mean, when we talk about emerging markets, I think Damien made the point, emerging markets are so heavily dominated by China, that really drives the story. If that's the case, I think there is a reason to be more optimistic on emerging markets at large. But for me, I really see a tale of two different stories. Really, you have China and everything else in the world. I mean, pretty much everything else out there is seeing, slowing profits and tightened liquidity. The reason that China specifically is so interesting to us right now is that it's doing the exact opposite of everything else in the world. Just as the world is about to tip into a global profits recession, China is actually poised to exit their profits recession, and at the same time they're trying to pump liquidity into supporting their markets. And so that's a very, very different story than what global central bankers are doing. So I think a lot of that story is very specific to China, and so I think that's probably the best way to play it.
Is that my new diversification, my uncorrelated asset?
It's definitely one of them, Jonathan. I think, for the last, people haven't really come to terms with this, but over the last, 3 or 4 years, China has been consistently, counter-cyclical. As the world was, entering into the pandemic freeze, China was actually holding up the best. As the world was coming out and surging, on the back of policy stimulus, China was a huge laggard. And now, as the world again is tipping into a profits recession, China is doing the opposite. So I think from that sense, China does make a great area of portfolio diversification today.
Dan, Damien's still with me. I wanted to give him the final word on that. Damien, I think this is such an important point coming into 23.
Yeah, no, I have to agree with one thing that Dan mentioned here. China government bonds, look, they were down 5.2% last year. That's the best performance of any fixed income asset class writ large. Chinese government bonds have been a good diversifier for your sort of core fixed income portfolio. But talking about China bonds and talking about Chinese equities are two entirely different things, right? So Chinese equities, while I take everything that Dan's saying about, margin improvement, about revenues, I mean, it's going to snap back certainly with the COVID reopening. But yeah, there's still a lot of risk in that market. And so look, I agree with you. You need to have some exposure. 0 is not the right number, but 2.5%, 5%. I mean, it starts to, it's risk, you know what I mean. It's how much you allocate to that risk.
This is the third year, though, of pandemic economics, and it gets extended by China reopening. And Dan, if we can finish there, I think it would be beneficial for all of us. On the demand side, it's pretty obvious to me how this works out. It's obvious to all of us. You get more demand, great, we reopen. On the supply side, Dan, it's less obvious to me whether we get supply chain relief or further supply side dislocations because of that burst in demand. Dan, from your perspective, which one is it?
Yeah, I think it's more the former. I mean, really, the one big, question mark for global markets today is, how fast is the reopening going to be? And if it is really fast, that is going to, do a great service to the rest of the world, because the reality is demand everywhere else is slowing. So there is excess capacity. We're not going to have those supply chain issues if it's really just China that's holding up the world. So I think from that perspective, that excess demand that's going to shield, global the global economy a little bit, I think that's generally going to be a positive. And I think the supply chain issues, sure there will be some targeted areas, but I don't think it's going to be much more of a positive story, I think.
I think we all know one thing with confidence, that the consensus is going to be wrong on something very, very big, and I just can't work out what it is. Dan Suzuki, thank you, sir. It's good to catch up, buddy. And to Damien Sasser there at Bloomberg Intelligence, thank you. Equities are up here about 23 minutes into the session, up 0.8% on the S&P with some sector price action. Here's Abby.
Yeah, and that gain is important, John, because we're looking at the first 5 days, at least right now, of January being higher. Some say that is a positive omen for the year relative to sectors. Not surprisingly, most of them are higher. Tech is the best, up 1.8%. Discretionary up 1.7% despite the drag of Lululemon. Lululemon is actually down for a second year in a row, down about 7% this year, in contrast to what we were talking about earlier. Consumer staples and healthcare defense, investors not wanting it. And take a look at the China trade. You were just talking about it. We have the NASDAQ Golden Dragon Index up 1.8% higher with energy. And we also have lots of hope that reopening trade is fully in play there.
Abby, thank you. Stocks building on the gains from Friday. The S&P up by 0.8%. Your trading diary up next. 26 minutes into the session, equities advanced by 0.8% on the S&P 500, led by tech with the Nasdaq up by 1.6%. Healthcare lagging just a little bit so far this morning. That's the price action. Let's get you the trading diary. Coming up, Atlanta Fed President Bostic speaking at 12:30 Eastern. President Biden meeting with AMLO at 5 p.m. Eastern time, followed by the North American Leaders Summit on Tuesday. Plus Fed Chair Powell speaking from Stockholm tomorrow morning. Another round of U.S. claims coming up later on Thursday. And then we get CPI as well, the big one. Then on to Friday, it's bank earnings in America. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Monday, January 9th. Here are the top market stories that we're following for you at this hour. Lulu's sour lemons. Lululemon cutting its margin outlook, the latest company to suffer from skyrocketing costs. That stock is down 10%. And Goldman's own cost problem. The big bank will cut 3,200 jobs this week, one of the biggest layoffs in history as markets losses balloon. And who wants a Rolls-Royce? Guy does. We speak to the company's CEO on demand and why luxury continues to crush it. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, there seems to be, as we head into earnings season this week, a huge conflict between demand, that top-line revenue, and then how much margins can actually shrink. Equities, though, in the meantime, they don't seem to care. They're up by a full 1 percentage point.
Equity markets are still reacting to what we got last week. Equity markets are still reacting to this idea it seems that we are potentially going to see smaller rate hikes and that maybe rates don't go quite as far and that we're heading for a soft landing. Everybody seems to be on board with that idea, I guess, until they're not. And Lululemon, I think, as you say, is an exact example of maybe where we're not. I think there's a line, I can't work it out, but there must be a line to draw between Lululemon, yoga pants, and what's happening on Wall Street.
Yeah, 100%. I mean, if you lose your job, are you going to spend $100 on yoga pants? And the idea is that you can cut your margins as long as your top line is good. If people keep losing their jobs, will the top line continue to be good? And if not, how else can you cut your costs? And what do you do in the meantime? And is that part priced in?
Yep. And also, if people are cutting jobs on Wall Street, do you want to be the person that's still stuck at home wearing your yoga pants, even though they are very expensive?
Oh, I see. You were trying
Maybe
to make it
not.
funny. I gotcha. Okay.
Not really funny. I think it's a serious point. I think most people are back in the office. Certainly the big Wall Street banks have pushed that fairly hard. But nevertheless, I think that kind of notion that you want to be showing up in the office is probably more relevant today than it was maybe 3 months ago.
Mm-hmm. Yeah.
We'll see.
Yeah, we'll see.
I don't know. Yoga pants at $100 seem quite expensive for me from the get-go anyway. But
you and yoga
that's
pants
a whole
in
different
general, that's tough stuff.
Let's yeah, there's images. No. Let's leave all of that for now. Our question of the day is, very quickly, how much weight, and I guess this goes to the same question, how much weight will Wall Street lose? Speaks to the Lululemon story as well. Let's talk about that now. Shonali Basak joins us. Alison Williams of Bloomberg Intelligence joins us to talk about what we're seeing here. Shonali, let's talk about what we've already got. Goldman Sachs 3.2 is the number apparently in terms of the job cuts that we're going to get. I thought the number was going to be north of 4. I'm trying to make this feel like it's good news, but is it?
Listen, the market is reacting pretty fairly to the news, and it's the point that you all are making. It's like, do you prepare here for tougher times? At the end of the day, you still want to keep your profits up. You still want to keep your margins higher as much as possible, even though the downturn is here. The downturn may be coming even further. Goldman is steeper than its peers. I would think back to what had happened just like a month ago, for example. We had David Solomon speaking to me and Brian Moynihan in a row. I got messages from some fund managers after saying that they appreciated the tough tone David took, because at the end of the day, this is a risk management business, and if you don't prepare for the worst here, then you would be stuck doing so again and again and again for the next couple of years. Well, what strikes me, though, Allison, is that if the job cuts are going to come across the board, despite the fact that it's markets that's struggling, if you're going to cut some of your investment banking and trading talent, does that sort of offset the ability to really make that top-line revenue?
Well, I think it's a recognition of what we've seen. So we saw drastically lower IPOs last year, as you know, coming off a record 2021. And it shouldn't be surprising that headcount is going to adjust to reflect that. I think what's important about the number, even though it's a large number in size, keep in mind that Goldman's obviously had a lot of growth in its employee base since the last time they did these cuts. And I believe, as Shonali has reported, it's looking to be only about a third or maybe a little over a third in terms of the amount of cuts that are going towards the banking and trading. A lot of the reductions are really related to the consumer business, where they're sort of regrouping and honing a strategy that's really going to focus on areas where they feel they have an advantage.
Alison, the other area that I've heard banks, particularly on Wall Street, talking about over the last few years has been technology. They have invested heavily in technology and the people they need to make that work. Are we going to see maybe a little retrenchment there as well? Are some of the tech jobs going to be at risk inside these big banks? Have they overinvested? Is it possible to overinvest?
I think the banks really do take a view of investing through the cycle, and that was really the big news, if you will, that we got last January when JP Morgan projected to the street much higher investment spending. And they have said, in their early look at 2023, that they expect that level of investment spending to continue, but grow at a slower pace. Mm-hmm. And this is really the new information I think we're going to get across the banks this month, because if you look at a lot of the other variables, we can track what's happening. We can see that net interest income is very strong, but close to peaking. We know that credit losses are coming for next year, But the question is on costs. We know that there's broad inflation pressure. And we also know that Solomon has also said that competitive pay has not come down as much as you would expect for some of the highest paid talent. So, we've seen some easing, but perhaps not as much as they had thought. We'll see what happens as these job cuts start. But the cost guidance, I think, is one of the bigger numbers that we'll get on Friday.
Well, yeah, the job cuts, but also then what bonuses and bonus cuts come in over the next few weeks as well. Hey, Sonali, is Goldman just idiosyncratic because they didn't lay off anyone really in the last couple of years because of the pandemic and they overinvested in markets, yada, yada? Or is this kind of the start and we're going to see the trickle down more than the regular culling that we're expecting?
I would say the reason to expect more of a trickle down is most of the big investment banks have not announced meaningful cuts to their investment banks itself. We've seen about a couple hundred over at Citi, Barclays. Credit Suisse obviously is a big outlier here, but most of the big banks have held fairly steady on that front. If Goldman comes out and says more than a third of these cuts are going to come from the investment bank, guess what? Goldman is number one. So that means that the other businesses that have pressure, they may feel that same kind of pressure. It just depends because they don't want to say so. It will signal some weakness. It signals a sense that, okay, we're not open for business, but the sense here is what they want to do, all of these banks, they want to keep the creme de la creme. They want to keep the cream of the crop at a time, to the point you're making, it's still a competitive environment. Not across every business line. The more that there's pressure on the tech industry makes your tech talent at your firm cheaper to bring on board. But right now, if you're an investment banker, the reality is, or a trader, there's still some pressure on the hedge fund side, and there's some pressure, by the way, of the big private equity firms that I know today are in talks for that switch that happens right after bonus season.
Okay, well, let's talk a little bit about that. One of the stories that I read a little bit earlier, Sonali, was about Ken Griffin, and I'm going to include Park Avenue on the Wall Street side here. You talk about what's happening in hedge funds. Are we going to see anything in terms of cost cutting there? Ken Griffin's talking about building a new tower block on Park Avenue. How different is Wall Street and Park Avenue? Let's kind of draw that distinction here in terms of the way that these different businesses are going to have to retrench. Are we going to see hedge funds doing any retrenchments? Are we going to see the likes of Ken Griffin having to make any changes? Or is this just on Wall Street? Is this just the banks that are going to have to make cuts?
The big story here, remember, a lot of hedge funds did really poorly last year, and you had the likes of Tiger Global, before the route that they were in, take significant talent from Goldman Sachs and other places, for example. So that tension was certainly there. But then you have these big multi-strat funds. Citadel also, the number two over there, the man right under Ken Griffin, also came from Goldman Sachs. The likes of Citadel, Millennium, these big multi-strat hedge funds, yeah, they are thinking ahead. The big is getting bigger. But I have to say, even among the banks, guys, something so important here is, remember, even with this retrenchment, if you come out of this next year and you see competitive weakness in the banking industry, you see Credit Suisse firing by the thousands, you see other banks that are potentially in a tough spot because of the macroeconomic environment, you have to then ask, what then are the ambitions competitively, even for the biggest global banks that are retrenching today?
Guys, really appreciate this conversation. It kicks us off very well, considering we get bank earnings on Friday. Sonali, Allison, thank you very much for joining us. So coming up, more on the question of the day, more on the markets as well. Daryl Cronk, Wells Fargo Wealth and Investment Management Chief Investment Officer, will be joining us. The S&P up a full percentage point now, above that 50 and 100-day moving average. This is Bloomberg.
really want to buy tech as a recovery story, so we need to put that market bottom in before we can really get to a point where you want to buy the tech sector. But we go back to this quality issue, Lisa, because if I take a look at all the S&P 500 sectors and rank them in terms of quality, that classic tech sector, software, semi-hardware, that component, that really ranks as the highest quality part of the S&P 500. So you might not necessarily get super cheap valuations before investors will move back in. But you do probably need to get better valuations, or at least more certainty around valuations than what you've got right now before you'll really see sustainable buyers come back.
That was Lori Calvasina of RBC earlier on surveillance with her outlook on the markets this year, which turns us to the question of the day is how much weight will Wall Street lose? And that ultimately becomes a margin conversation. Daryl Kronk, Wells Fargo Wealth and Investment Management and Chief Investment Officer, joins us now. We got it in tech, we're getting a little in retail, we're getting in the banks. Daryl, how much fat are we going to lose here?
I think a fair amount. We still need to, quite frankly. I mean, if you look at the fourth quarter estimates, we're probably going to come in around 4% revenue growth and -2, -3 earnings. 7 of the 11 GIC sectors are going to have negative earnings results for Q4. So it's still, that weight has to come off, and it needs to come off. The margin line is where it's all running at. I think it's interesting that this quarter will be the first quarter probably that revenue growth drops below the rate of inflation, which hasn't happened for the past several quarters, and that's going to really start pressuring that margin line, to your point, Alex.
Daryl, Wall Street's going to cut costs. Wall Street is brutal. When Wall Street cuts, they come thick and fast. What about the rest of U.S. industry? I take a look at what is happening in the labor market. I take a look at the daily data that we get on what is happening there. Claims is the kind of the weekly update, but there's plenty of other data as well. And what it's telling me is the companies do not want to fire people at this point. They do not want to lay people off. What does that signal in terms of the way, as you say, as revenue comes down, the margins are going to develop on the labor side?
Yeah, I think it's a really interesting dichotomy, Guy, because the labor's been so hard to attract and keep. But yet every day that they delay those layoffs is another day of erosion into the margin line. So there's an interesting push-pull that's going to happen here. We're seeing prices come down. So you now have the ISM manufacturing index is below 50 in contraction. So is services. Prices are coming down precipitously. I mean, if you look at later this week, we'll get the CPI reading. You're going to see core goods come down for the third month in a row. The manufacturing price index is at 39, which is down almost 50 points over the last 9 months. So as those prices come down, there's no doubt it has to land right on the revenue line, and it lands right on the margin line. And so they're going to have to make those adjustments or just accept extremely negative earnings growth.
Right. So why are stocks up?
I think it's what you guys hit on earlier, which is a little bit of the belief that we can somehow engineer a soft landing, right? I mean, if you look at the non-farm payroll report on Friday, you got wages to come down, you've got prices to come down, and yet employment remains robust, and that the Fed may be able to miraculously do this. I guess I find myself in a little bit of not that consensus camp, Alex, because, we still haven't even felt the full effects of the 75 basis point hikes in June and July, much less the 75 in September, 75 in November, and 50 in December. So there's a lot of contraction that still lies before us, even with what the Fed's already done, notwithstanding what they may do in February and March again.
Okay, let's kind of take that point a little bit further. Daryl, if we get to the point where the Fed is cutting rates, maybe it's later this year, maybe it's the beginning of next year, what does that signal about where I should be moving my portfolio? What does that tell me about what I do with risk? Do I buy equities as the Fed cuts? Do I anticipate those Fed cuts? Is that the right reaction? It's the right reaction from the last 10 years. Is it the right reaction for the next 10 years?
Yeah, it is the question, Guy, and it's the wise one to ask. I think you have to look at buying risk assets, and you look for that pivot moment ahead of the actual Fed rate cut. Now, history tells us, and it's pretty consistent on this, that you don't get bottoms in bear markets until after the Fed starts cutting rates. This time there's just so much capital on the sidelines waiting. We've seen it throughout 2022 in 5 or 6 solid bear market rallies. You could argue we're starting another one here in January as we bump up against the 50-day moving average right now that we're about 10% off the October 12th lows. So you're trying to get this market. It desperately wants to rally. It desperately wants to get on with the next new cycle. I just don't think we're there yet. And so at best, you may get a Fed, a Fed pivot to us is really the Fed stopping raising interest rates, not lowering rates at this point.
Hey, Daryl, if you need to be invested, though, where can you still do that?
Yeah, it's the right point. So right now, again, defense is still the order of the day. I know people get tired of hearing that, but you got to go with strong cash flow. You've got to, use the fixed income market. We think you barbell short-term and long-term. You get the falling rate environment of long-term as you get a flight to quality. Short-term rates are going to hold up with what the Fed's doing. On the equity side, you want to stay in places where the demand is more solid and not as affected by macro environment changes. So places like healthcare, where life sciences companies are going to continue to do well. Industrials and defense companies that we just know the omnibus budget just passed a 10% increase in defense spending. There's places where you can kind of play defense and still participate in today's environment, but you need to do it where they're non-correlated to macro environment and the demand is somewhat inelastic.
Daryl, are the best equity opportunities inside the United States or outside the United States?
It's a loaded question, and we've had a lot of those in our strategy committee meeting lately, which is, if you look at just past performance the last 3 to 6 months, you're getting Japanese banks breaking out, European banks breaking out. If you look at the developed markets, so shelf emerging markets, they were down 8 to 10% last year, which doesn't sound great, but when you compare that to the S&P down 18 to 19%, depending on if you're using price or total return, they've outperformed. And so as the dollar has come off and some of those currencies have strengthened, and the ECB likely takes the mantle as being the most hawkish and aggressive central bank on the planet, you might start to see some of those developed markets actually breathe some life back into them after a decade of underperformance, Guy.
Yep, it's been amazing. Lots of 52-week highs in European banks today. Lots of 52-week highs in European luxury. Daryl, great to catch up. Thank you very much, sir. Daryl Kronk of Wells Fargo. Still ahead, what are we going to talk about? Brazil's capital today recovering after supporters of the former president Jair Bolsonaro stormed Congress. The presidential palace and the top court were both involved. We're going to talk about the aftermath, the impact. How should investors read this? We'll talk about this next. This is Bloomberg.
Time for the Bloomberg Business Flash. A look at some of the biggest business stories in the news right now. I'm Ritika Gupta. Goldman Sachs is set for one of its biggest rounds of job cuts ever. Bloomberg's learned that Goldman is expected to eliminate about 3,200 jobs starting midweek. More than a third of those will likely be from within its core trading and banking units. Shares of Lululemon plunged today. The athletic wear maker lowered its gross profit margin forecast for the fourth quarter because of increasing costs. Lululemon says gross margins will decline by up to 110 basis points. And a one-time CEO candidate at Morgan Stanley is leaving the firm. Chief Operating Officer John Pruzan will exit at the end of the month to pursue other opportunities. CEO James Gorman called him a trusted advisor. Pruzan was one of 4 senior leaders given new roles in 2021 as they competed to be Gorman's successor. And that is your latest Business Flash, Guy.
Ritika, thank you very much indeed. The Brazilian president, Lula da Silva, vowing to prosecute rioters who stormed top government buildings yesterday in support of ex-president Jair Bolsonaro. Joining us now from Sao Paulo is Bloomberg's Brazil country chief, Julia Lecce. Julia, the scenes yesterday, incredible, reminiscent, you could argue, of what we saw in Washington, D.C. Has calm now been restored, or are there protesters still protesting?
You're right. The scenes were really unprecedented. We've never seen anything like it. It did remind us a lot of what happened in the Capitol almost to the day 2 years ago. For now, police has cleared the buildings. They cleared the buildings late Sunday. It's just a trail of destruction, what we've seen left behind. What you see today, Lula toured the buildings, just overseeing broken glass, throw people through chairs out of windows into the water that's right in front of the palace. It looks dire, but we don't see protesters there anymore. What we did see this morning was protesters moved to to a camp they've been making in front of a military facility, some 8 kilometers away from where the protest took place. And what we are seeing today is these protesters being cleared out of that camp where they've been for the past couple months, and into buses and into police headquarters for booking.
So, Julia, do we take from that this is now over? Or is this an overhang? Because I'm looking at an ETF here in the U.S. that tracks Brazilian equities, and it's a solid gap down, and down by that 2%. So I'm wondering what the trickle through there is.
It's hard to say what happens now. Lula did decree federal intervention in Brasilia, which essentially gives him the power to bring in more security forces. Congress will probably approve that in a few hours. But it's unclear what these people will do, right? You did see protests blocking federal highways again last night, and some other pockets of unrest. The response after the initial couple hours and the chaos was pretty strong. But you're right, for foreign investors, and for investors here too, it remains the question, what happens next, right? Do these people come back? How will Lula is just starting his 4-year government. He was inaugurated last week. So it's a pretty big question.
Julia, what is Bolsonaro saying?
So Bolsonaro, who's still in Florida, where he has been since late last year, he didn't attend Lula's ceremony, inauguration ceremony. He condemned the protests in a couple tweets, said violence is not the way, while also was very quick to distance himself from accusations against him made by members of the government, including Lula himself, that he essentially incited these protests. And he said he has nothing to do with this, and that's the last we heard from him or his family for now.
The parallels to January 6th are truly stunning. What does Lula da Silva do now? How does he restore confidence?
Another great question, Alex. So he will meet with state governors today, with the top court, and with Congress. They're really trying to put a united front to say this is not okay and this cannot happen again. We'll see whatever measures the government announces next. We're on the lookout for that.
Yes, we are. I mean, honestly, stunning video there, Julia. Stay safe. Thank you for your reporting. Bloomberg's Julia Lecce joining us there. All right, coming up, the JP Morgan Healthcare Conference kicks off today. It's the huge first event in 2023, and it leads us to the question, what's deal-making going to look like? Mark Cooper, CEO of Salomon Partners, will be joining us on that. And as we head here, the S&P is still up about 0.8%. 0.4% above that 50 and 100-day moving average. The dollar continues to break down. We'll get the market update for you as well. This is Bloomberg. We're about an hour into a pretty strong U.S. trading session. Bloomberg's Abigail Doolittle is tracking those moves. Abby, these are some strong moves on little news.
They are. We really got a rally on our hands. And importantly, for the first 5 days of January, we are now higher. Some consider that to be a positive, especially given the fact that the Santa Claus rally came to town as well, that it could be potentially a positive omen for the year of 2023. But to Alex's point, take a look at these gains for the S&P 500. You can see tech really outperforming, a lot of it having to do with the China reopening story. That NASDAQ Golden Dragon Index up 1.4%, and chips up 3.1%. If we take a look at what's happening relative to a driver for this, beyond that reopening optimism, we will see that the Bloomberg Dollar Index is down. In fact, the dollar index itself is close to what is called a death cross, essentially when the 50-day goes below the 200-day, a loss of momentum for the bulls and much more for the sellers. So here is that down dollar. You also have the commodity index on this up 1.5%, which it seems with investors may be okay because they're focusing more so on the dollar index being down as opposed to commodities being higher. Plus, oil and natural gas have been down so much recently, perhaps just a little bit of a rebound there. Now, where we also have a decline, well, that is in the retail space. Lululemon, of course, lowering gross margins once again for the current fourth quarter, now down 1% from up 10 to 20 basis points. This will represent the fourth down quarter in a row for gross margins. My thought is maybe run over to the Lululemon store. I'm not even a big shopper, but apparently their holiday 2022 didn't go so well. And you can see Macy's down as well, 7.4%. Earnings, of course, will be kicking off this week for the banks. We have some big news out of some of the big banks today, with Goldman Sachs ready to lay off about 3,200 people. Morgan Stanley, top deputy from the top, the COO, stepping down. Here is the bigger story, or at least as big of a story for the banks. This quarter, we're looking at net income declining, Guy, in a massive way, especially for some of these mid-sized, mid-range investment banks, Jefferies, Pipers, Evercore, and then take a look at some of the other ones here, Goldman Sachs, Morgan Stanley, all the way to BAC, Bank of America looking pretty good at down just 4%, but Evercore and these other ones down 66%. My gosh, it's going to be interesting to see how many more job cuts we are hearing about in the weeks and months to come for Wall Street.
Yeah, and it's going to really depend on what deal flow is going to look like in 2023. Abigail, perfect setup. Thank you very much indeed for our next conversation. How bad is it going to be? Well, healthcare investors and executives are in San Francisco beginning today for the JP Morgan Healthcare Conference. It's a big deal. Deal makers, though, are cautioning not to expect a big rebound in U.S. healthcare M&A anytime soon. And this is seen as one of the areas where at least there is an opportunity to play sort of defense for investors. For more on what's ahead when it comes to deal flow, Mark Cooper, the CEO of Solomon Partners, he joins us now. Mark, let's talk about the year ahead. We're already starting to see some stresses showing up. We're already starting to see Wall Street job cuts coming through. We're already starting to see people taking a very cautious line when it comes to deal flow. What is your expectation for this year? How tough is it going to be?
It's going to be tough. We saw this in the second half of last year, so it's the same issues as we're going to face now. They're carryover issues. They're interest rates. They're public debt markets that are non-existent both in the public debt markets, IPO markets, CEO confidence at low points. So and the expectation for recession. So the first half's going to be tough, in my view. Hopefully, you get a better second half when hopefully interest rates stabilize, the markets reprice, and hopefully the public markets open up.
So does inflation have to peak then for the deal market to open up to the extent that you're talking about?
Well, I guess if the Fed is not going to stop cutting interest rates, then inflation better peak. So I think it really has to do with stability and a good perspective on what the future holds. And that's when the debt markets open up, and that's when pricing will equalize, because right now there is a bit of a mismatch between buyers and sellers, which generally happens when markets change as they have. So you need to have greater visibility on where demand will be. You need to have greater visibility on what the cost of debt will be, both of which drive valuation.
Yeah, how long do you think that lag could be, Mark?
Well, your guess is a bit as good as mine, because it's all back to the Fed and the Fed's willingness to cap out its interest rate increases and willing to call it quits on the fight on inflation, as Alex mentioned. Hopefully that does happen sooner than later. Now, it's not as if transactions won't get done. They will. In fact, you mentioned healthcare. Healthcare will be slower, but it also is a very good time for opportunistic transactions when people are trying to backfill into growth, backfill into categories that they have been looking for with valuations being lower. But it's not going to be robust. It's not going to be a very active market.
So, Mark, where will you see the most activity in a weaker market, and where is just like totally closed right now?
So IPO markets are totally closed. Recession-resistant companies are going to be more in vogue than those who will do poorer in recession. So, think about consumer cyclicals not being the place you want to be. Frankly, healthcare is recession resistant, so you could see transactions there. Technology generally is, but right now it's going through its own issues, as you been reading about with all the cuts in employment and technology companies, and that's just a function of them getting a bit of ahead of themselves in the 2021 market with zero interest rates and demand that was really unsustainable. So it's going to be selective. It's not going to be only sector specific, but it's going to be selective. But there are some good markets. We have a big business services unit out in Chicago, and there are some interesting businesses that are just not going away during a tough market because they're critical to industry.
Mark, what kind of year do you see private equity having? You look at the vintages over the last few years, IRRs have been coming down sharply. What do you think 2023 is going to look like? How does private equity navigate the kind of landscape that you're describing? Can it navigate the kind of environment you're describing?
It can, it has, it will continue. This is just another cycle. They all have their nuances, but it's a cycle. The two pieces of the puzzle are, one, returning capital to their investors. And that's the big issue we all hear about is the denominator effect, and the funds not having, or the investing community, the LPs, not having the liquidity to continue to invest in new funds. And so you will see transactions pick up that have been put on hold for 2022 that will sell this year, even at lower valuations. But that raises the next issue, which is a positive. It actually is a good time to be an investor in private equity because you are going to be buying at better valuations. It's just going to be that way. And so those who have the capital and those who have the conviction are going to be making good investments this year.
Mark, I feel like I keep reading, though, about how private equity doesn't have to mark-to-market their assets. It's just they write down the value or they mention the valuation based on what they think it actually is versus public markets that have to really do that, and that there's a huge discrepancy and that the chickens are going to come home to roost for private equity. You don't see that as a risk at all?
Well, the risk is realization, of course. Yes, you're right that realizations could be far lower than where their marks are. I am not of the view, being in quite a few private equity funds myself, that they take unrealistic views necessarily of what their valuations are. In some cases, they actually are lower. The real issue, though, is they need to get cash to investors. And so, yes, even if they're going to take lower returns, they're going to have to get cash to investors because the investors need the cash. And the model for private equity is to continue to raise the cash, right? They are an asset class. They're money managers, and they live and breathe through investing their capital and continuing to raise capital, invest more. So, like I said, I think there'll be transactions done this year. They won't be at the valuations that we saw over the past couple of years, but they'll be fine. And I think it'll be the beneficiary of this will be the private equity investors who are putting money to work.
Mark, final question. It's our question of the day. We're looking at job cuts on Wall Street. Our question is, how much weight does Wall Street need to lose? As you watch this slimming process unfold, how brutal do you think it's going to be?
Pretty brutal and not surprising. So if you look at 2021, it was one of those Goldilocks years. I mean, everything worked. And even things that weren't even in their sights worked, like the stock market. So what happens? They hire and hire and hire to reach peak capability to drive every single dollar out of the system. And then you hit 2022, rates go up, markets go down, and IPO markets close, debt markets close, you name it. It's the 180-degree turn. And what do they have to do with those people? They have to cut them.
Yeah. All right, Mark, hey, we really appreciate it. Thanks for joining us. Always fun to catch up with you. Mark Cooper, Salomon Partners CEO. And picking up where we started here, we're going to have a lot from the J.P. Morgan Healthcare Conference. Tomorrow we're going to hear from Cigna's CEO. Also, we got Novavax as well. And then on Wednesday, we're going to have the CEO of Takeda Pharmaceuticals. So don't miss our full coverage from that conference. All right, coming up, Rolls-Royce riding high on some record sales. Luxury car makers selling over 6,000 cars despite a drop in Chinese demand. We're going to have more with the CEO, Torsten Müller-Ötvös. This is Bloomberg.
Keeping you up to date with news from around the world, here's the first word. I'm Ritika Gupta. Bloomberg's learned that the UK is considering sending Challenger 2 battle tanks to Ukraine. That would be the first time in a Western country that has given Ukrainian forces tanks to fight Russian troops. Last week, the US and France announced they are sending infantry fighting vehicles to Ukraine. The capital of Brazil is recovering from an insurrection by thousands of supporters of former President Jair Bolsonaro. Rioters ransacked Congress, the presidential palace, and the top court in Brasilia on Sunday. It took hours for security forces to regain control. New President Luiz Inácio Lula da Silva is vowing to prosecute the rioters. And in China, angry Tesla owners swarmed showrooms to complain about missing out on another round of price cuts. The company has been trying to boost sales in the world's largest electric vehicle market, and it cut prices by as much as 14%. That followed a round of discounts back in October. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Alex.
Hi, Ritika. Thanks very much. Always wait for sales. That's what I say. Okay, Europe's luxury autos are getting a nice boost this morning. A lot of those stocks hitting 52-week highs. Citi had a note saying that Mercedes and Porsche are some of their top picks. The analyst also upgraded Ferrari, pinpointing its relative pricing power as a key differentiator. Now, Rolls-Royce Motor Cars, which is owned by BMW, BMW also reporting a record year for sales. It sold more than 6,000 cars for the first time in history. And joining us now is Rolls-Royce Motor Cars CEO Torsten Müller-Ötvös in front of a Spectre, which is Rolls-Royce's first EV in a beautiful color there. Torsten, appreciate it. How long can these good times roll? Can you keep hitting record sales month after month, year after year? When is it slow?
Yeah, good afternoon, first of all. No, I'm very delighted that we broke again a record, first time ever over 6,000, which is quite tremendous. But even more important than volume is the average price we achieved for all the Rolls-Royces we have sold worldwide. That was for the first time ever around $500,000 each single car in average, which is also quite an achievement and also indicates the pricing power we own and also the strength of the brand, obviously, and also that luxury is booming because we are not really in the car market, we're in the luxury goods market, and I think that market has seen quite some tremendous growth patterns over the last years. Is that continuing for the future? Probably it's slightly cooling this year, but I still see that there should be overall some growth potential, not only for us, but also in general for the luxury market.
Torsten, good afternoon, it's Guy. So do you think 2023 is going to be a sub 6,000 year, or is it going to be a plus 6,000 year?
Let's see, it's very early in the year, second week. I'm cautiously optimistic, Guy, about this year. So I think it will be again a strong year for Rolls-Royce Motor Cars. Are we getting on even higher levels? Let's see. But I think we also sit on a very good order bank. Our order bank reaches far into the year already. And we haven't seen any downturn in order intake here over the last months. So for that reason, it's quite a stable business, allow me to say that. But obviously, we are not immune against recessionary tendencies.
Yeah.
But I think due to the fact that we are globally well balanced, it's looking good.
Torsten, if you look at those recessionary fears, where are you most concerned right now? Where might you be seeing the most slippage?
No, I mean, you might have seen, and we talked about it, that China has seen a little drop compared to the previous year. That was very much due to the circumstances in the market, COVID related, obviously. But I must say, still the second strongest year in history also in China. So a fabulous job by the team over there. Let's see how that plays over the next course of months. Once the pandemic is over in China, I foresee again growth patterns to happen there as well. The rest of the world is pretty stable. Also, when I look into, as I said it already, order bank coming in, all good. I can't complain currently. I'm, as said, cautiously optimistic.
Okay, let's just talk about China a little bit more, Torsten. You described it in your release today as being a headwind in 2022. Is it going to be a tailwind in 2023 now that we do see reopening? We're already starting to see in Europe a huge focus. LVMH is tracking higher. You've got Dior tracking higher. All of these companies are being bid higher by the stock market because of an expectation that there will be a tailwind out of China this year. Do you agree with that?
I would say so, yes, but there's one big difference. We are not, let's say, in a kind of shopping spree in Europe by Chinese clients. That doesn't work for a Rolls-Royce. A Rolls-Royce needs to be bought in China, so it is all about what happens in the Chinese market. And if that market also opens up again far more and COVID turns down, then I definitely see also tailwind to happen. But that is, again, something what is difficult to judge currently. What is a great relief is that there is travel back and that people can travel. We have seen 3 years ago lots of Chinese clients here with us in Goodwood speccing their cars, bespoking the product, and that will definitely come again. And I'm very much looking forward to welcome our Chinese clients back here in Goodwood.
So Torsten, that brings me to the car behind you. I mentioned it was Spectre, the first pure EV from Rolls-Royce. Can you talk about your order book for that, and are the customers that are buying that different from your usual customers?
Yeah, both is true. I mean, first of all, the order book is really very strong. It's exceeding our highest expectations, allow me to say that. And it resonates extremely well that we are going electric. And it is, I would say, one portion of existing clients who love it because it's a Rolls-Royce first and an electric car second. And then there are also brand new clients, clients we haven't seen before, who are for the very first time now with the brand due to the fact that we go electric. I think that's a nice proposition and is also underlining our strategy to be fully electric by the end of 2030. So the entire portfolio will be electrified over the course of the next years to come.
Torsten, the Cullinan is your luxury SUV. Do you think that will ultimately, is it inevitable that the SUV becomes the best-selling Rolls-Royce of all time? Do you think it becomes your bestseller? What are your expectations?
It is already our bestseller. So it is close to 50% of the volume we have achieved last year. So it is going from strength to strength to strength. But also Ghost was very popular, over 30%. 10% is Phantom. And then obviously the rest is, the 10% rest is Wraith and Dawn. And you know that we have ceased production for both cars. That's the reason why the volume is more or less minute on those. But I'm very pleased to see that all three models performed very well for us. Phantom, Cullinan, Ghost.
Torsten, before we let you go, just bring you back to CES last week. BMW unveiled a car that basically has no buttons. It's a real concept car integrating a lot of potential voice control technology. Are you going to be looking at something similar in the future?
I mean, I found that extremely interesting, what was presented here by our mother company in Las Vegas. And definitely, I mean, particularly when it comes to color changing modes or whatever, why not? And one day it might also be interesting for us to do similar things. There's one big difference. We are not really in the car industry, we're in the luxury goods industries. And Rolls-Royce is not being taken as a digital car to come from A to B. It is taken as a luxury good, something that you bespoke yourself, where you put your signature on. And it is to indulge, and that is, I'm quoting now client, a kind of digital-free, toxic-free ambience, something where you can really enjoy yourself sitting back, driving the car and smelling the car, enjoying every detail. That's more what Rolls-Royce stands for. But obviously, we are very much looking into it.
Have a great year down in Goodwood. Torsten, thank you very much indeed. Torsten Müller-Ödvös, Rolls-Royce Motor Cars CEO. Thank you very much indeed. This is Bloomberg. Sorry, European stocks going from strength to strength. Stock 600 up by around 1% right now. We're trading at 448. We're up nearly 20%. I think it's 17, 18% now from the lows we hit in September. We are continuing to crack high. So banks are having a really good day today. You've got a lot of 52-week highs in the banking sector. Luxury, as we've already been pointing out, lots of highs there, 52-week highs as well. Euro dollar up by around 1 full percent. Very nice note out from Steve Englander on what's happening. He's very positive about the euro. Another factor that's driving things as well is what's happening with Brent crude. We're up by 2.6%, so the energy stocks are having a really solid day. The close is coming up next. Bilal Hafeez is going to be joining us. That's next. This is Bloomberg.